Hey, good people, how are you doing? Good to be with you. We are looking at the yield curve, 10s and 2s, begin its move towards the zero line where it will revert back positive. Your major capitulation phase of your recession is now, in our view, here, very much indeed. By the way, payroll numbers were in today, those that did not join us for our live trading day on Nonfarm Payrolls will become distinctly aware that we are in a rather interesting state. Let's just show you those numbers. Average hourly earnings came in under the expectations. Non-farm employment change came in well below an already banker-managed low consensus. And the unemployment rate came in higher, quite substantially. 0.2 is a lot when you are multiplying it by 300 million population versus what was expected, which shows a greatly reduced or decaying employment environment for Americans. That's right. We spoke about how the Q1 of this year was everything is still awesome, and how the data pivoted roughly from March, going April further on. And in fact, we also highlighted a long time ago that America was already in recession. And we've highlighted before that the Fed chase lagging indicators, and they are always late to do cuts and or increases in rates. In other words, they are laggards by a country mile. They are now flagging cuts expected for September, which would now slightly higher probability, 65% probability that it'll actually be a double cut. As usual, they've got a chase now with a bit of FOMO, which is going to smack of fear, I imagine, in terms of the economy. Let's also highlight, as pointed out here in zero hedge, payroll changes, that you've had almost, I think it's 10 revisions in a year in terms of the non-farm payroll numbers. So the number that comes out is almost invariably dishonest. We've called it the fake number before because of the birth-death number, but we've also highlighting the fact that it gets moved south later quietly on many, many occasions. And you can see these revisions here on this chart, which show previous months being moved down. 1, 2, 3, 4, 5, 6, 7 revisions alone here to the downside. So typically that is the direction of revisions as well. So not only is the number you're getting right now not necessarily a hard number, in most instances it's likely to be revised lower at some later point when the reaction to the number is not so critical. Everyone's reacting to the new fake number. If that makes any sense, we're here to tell you that you are about to get the name for this recession. No doubt it'll get its name. We've highlighted the 3 indicators why we say you are deep in recession, and were when you met the criteria, not because they said, no, it's not a recession. Yellen and a whole bunch of bankers and talking heads came out and said, no, not recession. Labor, red hot labor market indeed, for pizza delivery boys, no doubt. Anyway, so our primary call is that the market is not in a good shape and is further to decay, and that you are now in a capitulation phase. And our expectation is that oil will likely break down to the downside as a result of this, and that you're going to start to see a reflection of reduced consumer demand, if you haven't already seen it, reduced tendency to travel, reduced tendency to get packaged goods, delivered items, drivers having to take things out, on the basis that oil could indeed crash quite substantially. You may, however, also hear of potential output cuts to attempt to try capture the decline of oil. And we want to give you our inverted HVF draw and where we see a stop placement for us, a potential trade. and you could do a 50% closure at the 52, but we also think there's possibility for an even deeper dip if this potential recession reverts worse. Could we be wrong on the squeezy? You always could be wrong, and how would we be wrong? The end of this particular trade would be on the takeout of 84.49. Things like major scale wars would be one manner by which those rates, oil prices could in fact go higher, and or such significant oil cuts that are remarkably reduced. However, in this environment, I would expect that it's going to be very difficult to keep oil prices particularly high. And as we say, a target of 52.54. We could also in due course see the beginning again of the gold long oil trade short trade, which was very similar type criteria for the recessions before. Also, by the way, there is a slight possibility, and this is not a hard call, this is an exceptional call. If this were to escalate into a really bad downturn, that is very, very debilitating for the markets, and you would know about that. You could in fact have a situation where you could see as low as $32 on oil, on the basis technically that we might. This is a longer shot. This is a much lower percentage possibility, but it does exist. It's being underpriced in my view. You could in fact have that double shoulder there, that big head down into there, and there's an interaction with the $65 mark. If this were to continue to go to the downside at the rate we expect, you could trigger the 65 downside on that and could end up at a 32.81 potential, with also possible overperformance to the downside as a result of consumer being crushed, interest rates still being relatively high, even though a half point is being cut, and other contagion economic events. So overall, fear is back in fashion at the moment, and you could find yourself in a situation where your best trade could be short oil. And to some degree, even though gold reacted initially quite badly to the non-farm payrolls, there's a fear out there. We'll show you the gold market. Longer run, we see potentially the gold market being the only thing that protects you against debt collapse, that protects you against inflation in a manner that is reliable, and you could in fact see gold doing rather well. So if we were to take a gold versus oil trade here, for example, you could be long gold and short the oil. This is a commodity neutral trade, so we are short oil and we have some longs on, and that would bring you into the realm of this reversal that we see, which could see almost 61 barrels of oil required for 1 ounce of gold. Don't forget, down here you're as low as 14.7 barrels of oil for 1 ounce of gold. So that could be, if oil went so far as, let's say, $47, you would multiply that by, let's call it 61 for want of a number. You'd be looking at around 2,867 on gold. If oil fell to that 32 mark, that would mean obviously a very, very deep dip in the price of oil. That would be severe on the recession. Gold would not be as high. If we were in the low 40s, for example, say 40, 42, you would be in and around 42 times 61, and that's probably roughly a couple of $100 higher on gold for us here. So it depends how much of this is going to be in the contractionary side of oil versus the expansionary side of gold. Don't forget, gold can sell off if we have the sudden super fear, contagion, news, events, all that break out. You can get the sell-off, but it will typically rebound very, very strongly to the upside as central banks replace treasuries with gold as purchases. Okay, so we've given you something to think about. Real fear out there. You're seeing the stock markets adjust. You had a gap down on that. The notion of a red-hot labor market is certainly been unwound by now, despite the tales they did tell you back at the time, and you've probably been in a recession longer than you realize. So typically it's bad news to realize you're in a recession that is not yet been acknowledged. You've probably been in it for a while already and you're already coping. You may get the capitulation fear and headline stuff coming in the not too distant future. But that usually means you're halfway into it and you're now heading out. What will be the solution? Will it go into a real contagion that will be the reset? That remains to be seen. But there you go, a couple of things to think out. I am currently short oil at the moment, and I am holding a long on gold. Till next time, we'll catch up with you later. Hope you enjoyed the update.